In this presentation, we will take a look at leases, comparing and contrasting capital lease versus an operating lease, thinking about when we would have to capitalize a lease, when we would have to call a lease a capital lease versus an operating lease, and what are going to be the differences in terms of reporting a capital lease versus an operating lease. Most leases are going to be operating leases when we think. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Think about a lease, we typically think about an operating lease, unless there's going to be conditions that are met that will require us to record it as a capital lease. So let's take a look at the two differences in terms of recording just in general. What are the type of recording requirements for an operating lease and a capital lease, and then we'll talk more specifically about what those conditions will be in order to require us to record something as a capital lease. The operating lease is what you would think. We're going to lease something, and then when we make the payment, we're going to record the payment of a credit to cash, and then rent expense or lease expense is what we have. So in this case, it's really easy for us to record in terms of just journal entries. We can just say when we make the payment, that's when we record the expense. This would normally be the case because we assume, of course, when we lease something, if we leased a piece of equipment, we assume that that piece of equipment is not ours, but the person who leased it to us, the lessor. Us as the lessee are just using it, and therefore the lease payment is going to be the expense related to us using the property, the equipment, in order to help us generate revenue, and therefore it would make sense for us to expense the use of the property as we use it in accordance with the matching principle. So that would be normal. That would be what we would think of as a normal lease situation here. However, it's possible to have a substance over form type of lease situation, in which case the lease could be set up as if it's a lease, meaning we're going to set up these lease payments. However, in actuality, for all practical purposes, it's pretty much the same as if we purchased it. Meaning, and we'll take a look at more of the conditions, but if the lease is set up in such a way that we make payments equivalent to the amount of the purchase price of the property that we're buying, and we're guaranteeing to make those payments, and the payments would look very similar as they would if we were to just buy and finance the equipment, then that's one way we could look at it and say, well, it looks like you set it up as a lease, but in actuality, it looks like your contract is such that it's very similar to one that would be there if you purchased it. And therefore, it looks to us more like it's something that you purchased, even though it's being set up as a lease. Now, why would someone want to do that? Notice that if we set up this situation here where we have an operating lease, then we're not recording any liability on the books here. So notice we're just expensing things as we make the payment. However, if we were to purchase this piece of equipment, then we would have this liability on the books for the amount that we financed. And so it's possible that a company may not want to have the liability and therefore purchase a piece of equipment and make it be theirs. They basically have ownership of it. However, set it up kind of like as a lease so that the liability component won't be on the balance sheet. That's one reason that substance over form argument could happen, meaning something could be set up as a lease, although it's actually more of a purchase situation. If that's determined to be the case, we'll talk a little bit more about the types of conditions that could be met in order to have something in substance be really a purchase when it's set up kind of as a lease. But if those conditions are met, then we'd have to put it on the books more as if we were to have purchased it, because really that's what happened. And if you look at the lease, it really looks like we actually purchased it. So in substance, we did, and therefore, to be transparent on the financials, we should record it as a capital lease. What does that mean? Well, that means that when we sign the lease, we want to put the equipment on the books as an asset, as if we purchased it. So we're going to put the equipment on the books as if we purchased it, and then we'll credit an obligation under the capital lease, meaning a liability. We're going to credit a liability because we're treating this basically as if we're financing this piece of equipment, kind of like if we bought it. So even though it's set up as a lease, we're going to have to say substance-wise it looks like a purchase, and therefore we're going to put it on the books as an asset at the purchase time, and we're going to set up the liability. Now, we're not going to get into a lot of detail in terms of how we're going to get to these numbers. What is the purchase price? There's different methods we'll have to determine, what the actual purchase price is going to be. But just in theory, note that, of course, we have to capitalize the asset rather than not having it capitalized, and therefore also have to recognize the fact that we owe basically a loan, a liability on the books. When we then make the payments, when we make the lease payments and we've capitalized the lease, then we're going to credit cash just as we would under the operating lease. But now, rather than record lease expense as we would under the operating lease, we're basically treating this as a loan. We're paying off the loan. So this is kind of like the loan payable account that we're calling obligation under capital lease. That's basically our financing account that we've recorded as a liability. We're paying part of that off. So we're going to pay off the loan, and we're also going to have an interest component that we've imputed, we've figured out based on this first information. When we recorded this first transaction, we assumed it was a purchase. We calculated this as if it was basically a loan with an interest rate. And now when we're paying off, making the payments, the cash is still going down, but the entire payment is not going to be going to an expense like lease expense. Some of it's going to be expense, but that's going to be for financing. It's going to be in the interest expense. And then the rest of it's going to reduce this liability we set up, just like if we financed it, just like if we have a loan on the books. And then we're also going to have to deal with, of course, the depreciation related to this equipment. We put the equipment on the books. We've purchased it now, in a sense. It's a capital lease, which is like a purchase. And therefore, we're going to have to record the depreciation related to the equipment as well, which is just normal, any kind of depreciation we would record for property, plant, and equipment. We would debit depreciation expense and credit accumulated depreciation. So we can see, of course, that the operating lease is a lot easier for us to record and put on the books. And most leases, if it's just renting, and if it's truly renting, and what we're renting is not our property, but it's the property of the leaseor, and we're just leasing it for a time period, and then we're going to get a normal rent situation, then this would be appropriate. And again, the capital lease really happens when substance over form. Substance meaning, in substance, we're buying the thing. The contract is such that it seems a lot more like a purchase than it does a lease. And therefore, to be transparent, to really report properly, we should put it on the books as a purchase. So when would we have to do this? When would we have to do this capital lease? Well, there's a couple conditions, and you can kind of think of them yourself, like what would have to be met in order for something to be substantially, in substance, a purchase, whereas in form, the document that was put together just looks like a lease. Well, maybe the leasee automatically gains ownership of the asset at the end of the lease. That would look a whole lot like a purchase, right? I mean, if the lease says you're guaranteeing these payments, and then at the end of the lease, we're just going to give you the thing, right? The equipment's yours at the end of the lease. Well, then at no point in time, there's no, was the equipment really someone else? We own it. This person, the leasee, owns it. In essence, has control over it, is using it, and then at the end of the lease term, they're going to transfer the ownership from the leaseor to the leasee. Well, it looks a lot like the leasee basically has control of it the whole time, if that's the case. So if this was the case, then we would probably say, well, yeah, you have to record that as a capital asset when you make the lease, at the beginning of the lease, because it looks a whole lot like, in substance, it's a purchase rather than a rental. Another one, if with the lease, the leasee can buy the asset at a bargain price at the end of the lease. So obviously you can think of if you wanted to get around this first one, you can think, well, maybe they don't get it for free at the end of it, but maybe we give them, they have to pay me $1 for it. Well, obviously $1 seems a whole lot under what the value. I mean, they would. So if they're going to pay something that's very small at the end of the lease term in comparison to the value of the piece of property, then again, that would still seem like, well, that seems like they would do that for sure, and therefore it looks like it's still going to be a capital lease in that case, because again, the leasee, basically has ownership through the whole thing, and there's no way they're not going to pay a bargain purchase price like $1 at the end of the time period in order to purchase the piece of equipment. And then the lease runs 75% or more of the asset's useful life. So, and this is kind of an arbitrary number, 75%, but you can think what they're trying to say here. What we're trying to say is, well, I mean, if you're leasing if you're guaranteed the lease, if you sign an agreement that I'm gonna own this car for, you know, 10 years, and the life of the car is 10 years, and there's no way to get out of the lease, you basically purchased it because the lease term is as long as the life term. So if that's the case, then you've basically leased it for the entire life, and that would seem more in form like a purchase than a lease. Present value of lease payments is at least 90% of the asset's fair market value. So this would be just based on price. So if we were to try to look at the lease payments, what we would have to do is use present value. We would have to say, okay, if you have, you got these payments that you're going to make for so much a term of the lease, and we know exactly, what's required to be paid, then we can try to figure out then what the present value of those lease payments are. And if the present value of the lease payments are 90% of the fair market value of the equipment, then again, it would look a whole lot like you've signed something, you've agreed to something that looks like a purchase rather than a lease. So again, you can kind of derive these type of things when you try to think of it. It's a substance over forms argument. We're trying to say, it's possible that some people might have an incentive to set something up as a lease as opposed to a purchase in form, when in actuality they want a purchase agreement. And if you think in those terms and you look through agreements skeptically, trying to say, okay, let's see what kind of conditions would be met, you'd probably come to some of these conditions. When the lease obviously looks a whole lot like a purchase, or it's set up pretty much as if one person, the leasee, has complete control over the equipment, then you would think, okay, it looks pretty much like in substance this is going to be a purchase and therefore a capital lease rather than just a lease, which would be a normal operating lease. For more accounting information and accounting courses, visit our website at accountinginstruction.info.